Welcome to Yahoo Finance Live. It's Tuesday, January 31st. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on this afternoon's market action as we get ready to wrap up the month of January here for the markets. And it certainly has been a strong month. On an intraday basis, we're looking at gains of just around 210 points for the Dow over the last month. We're looking at gains of just over 2% here. The S&P is still well here to the upside. Over the past month, we're looking at gains of over 5.5%, up just about 1% today, but the Nasdaq has certainly been the outperformer over the last several weeks. We're looking at gains of just over 10% for the month. The Nasdaq 100 also leading the way today, as we certainly have seen. There's a bit of a reversal in terms of what investors, what traders are favoring here this year, certainly betting on some of those beaten down names that we saw certainly get hammered during the month or during the year of 2022. Taking a look at some of the trending names here, a big day for earnings. GM, McDonald's, just some of the names here reporting earnings. Taking a look at General Motors on an intraday basis, we're looking at gains of just about 7%, strong results there. Spotify popping about 12.5%. We'll dig into that in just a little bit. ExxonMobil, another strong report here from that company ahead of the bell, up just nearly 2% on the day. Record profits from Exxon following in the footsteps of Chevron last week. Taking a look at that sector action on an intraday basis, mostly green on the screen. You're looking at consumer discretionary leading the way, up just about 2%. Materials, real estate, not too far behind. The laggard in today's action has certainly been utilities. I mentioned some of those earnings reports. Let's take a look at, more broadly speaking, the energy sector. A bit of a mixed picture, but Exxon certainly the winner today, up nearly 2%. Chevron, on the other hand, one of the underperformers inside the Dow. You're looking at Chevron off just about 0.1%, Dave.
And the White House taking aim at both of them today, Shauna. We'll get into that a little bit later on. Thank you. Let's get you up to speed now on the auto sector. Wall Street's concerns over weakening demand continued to grow after Tesla and then Ford announced EV price cuts. Meanwhile, GM CFO Paul Jacobson says it's staying out of the industry's EV price war. Listen.
We've seen incredible demand for our EVs, and we're launching even more this year. And we've seen consumers, really run towards them at the price levels that they are. So we feel quite confident with our strategy. Look, competition in this business is no surprise. We've been dealing with it for more than 100 years, and one of the things that I think we've said over time, this isn't an easy business to get into, but one that we're ready for.
Translation, we're good. Our very own Praz Subramanian is here with more on this. So is there a pricing problem in the sector, or is it pretty isolated at this point?
I think you could say it's company by company in terms of what they need to kind of get done to meet their their goals, right? Speaking of GM, huge quarter for them. Strong results, strong guidance. I have some key takeaways here, like you mentioned. They blew the doors off 2022, record Q4 revenue, and then 2023 EBIT guidance really strong there. Citi called it solid. Morgan Stanley said it sets a high bar for the year, so really strong performance financially there. And like you said from Paul Jacobson, pricing not a problem. He said that they don't need to compete on that level. Mary Barra really hit that hard. GM CEO in the conference call saying that we got the cheap Equinox coming out, the cheap EV Blazer, the Silverado work truck all coming out this year. They're all going to be below that $55,000 EV tax credit price cap. So they're pretty happy where they're at with these cheaper EVs. So they don't see the need to cut prices like Ford and Tesla are doing right now. And then finally, demand is strong there. They're talking about how they're the number one large truck maker, large SUVs, mid-size pickups, full-size pickups, number one over Ford. And then also the Chevy Bolt EV had its record-selling year this year. They're going to increase output next year. So they're confident they have the right game plan in place, right portfolio in place to sort of do that.
And even invested $650 million in Lithium Americas, which popped 13% today. An interesting sidebar to their report, Shauna.
Yeah, Praz, it was interesting what you just said when you compared all three, when you compared Tesla to GM to Ford, what we're seeing in terms of pricing. Obviously, we got the news last week about Ford cutting the price of its Mustang Mach-E. Why were then they forced to cut prices? And does this signal that maybe we could see broader price cuts at Ford?
So that Mustang Mach-E is really battling head-to-head with Tesla's Model Y. And after Elon Musk cut the price of that truck or that SUV by 20% at certain levels, Ford had to respond. It seems that some of those trim levels might be selling at a loss for Ford, but they said that we're not going to cede ground in this battle. So they see it as a protracted sort of winner take all, who can kind of live out these sort of margin compression type of battle. But I think Ford understands that this is the beginning of this, and they're ready to do that. But also the F-150 Lightning, they're not cutting that price. They've raised the prices. They can't sell enough. So it's only for specific, I guess, product models and product segments.
Yeah, I think there was too much made of the cut at Ford. There was one automobile that they cut prices on, and only because, to your point, it's a direct competitor with that Tesla model. I think a little bit too much made.
Yeah, but it's also important to point out that GM did cut prices, 6 months ago, back last summer, in terms of some of their EVs. So there certainly has been a pricing war brewing now for quite some time. Huge price cut
for both, yeah.
Yeah,
and it ginned up sales.
And they did, yeah. Certainly, it seems to be working out, at least in their favor for now. All right, let's get you up to speed with McDonald's, another big mover here. The company reporting better than expected earnings, yet we're looking at the stock off just about 1.5%. The beat coming after McDonald's raised its prices by about 10% in its previous quarter to combat those higher operating costs that we've been hearing about. Now, to put the prices in perspective, we took a look at some of their most popular items. You have the Big Mac, fries, and the McChicken. So this is comparing to prices back in 2019, about 3 years ago. The Big Mac price is up 7%. Fries have jumped nearly 25%. The McChicken up nearly 28% despite these price hikes, Dave. It looks like when you take a look at some of the traffic inside their stores, consumers are trading down to McDonald's and willing to spend there.
Look, when I look at this report, I'm shocked at the investor reaction across the board. They do say their prices, to your point, up 10% on average from a year earlier. But dive inside these numbers. U.S. visits up 26%. That's from pre-pandemic, from 2019 levels. They're up 30% from a year ago. And if you want one more thing, how about an operating margin of 45%? That was 40% a year ago. They have raised prices. Consumers continue to pay it. And we have seen in the past, McDonald's has proven to be recession resistant. I think it's a pretty stellar report.
It is a stellar report. And also when you look inside and see what is working for McDonald's, yes, they're able to raise prices. Yes, consumers are continuing to spend. But some of their initiatives, we talked about the McRib. That clearly was a huge hit for McDonald's. I've never had it. Have you?
Oh, yeah.
Do you like it? You have? You've had a McRib and not a Big Mac?
I have had several McRibs in my life. The texture bothers me now.
Does it live up to the hype?
As a young kid, the texture will freak you out.
Yeah.
And I can't do it anymore. But as a young kid, I loved it. Still never had a Big Mac, though.
Yeah, that blows my mind. Their fries are my favorite. McDonald's fries are my favorite, but they're not yours?
No, not close. Wendy's, but I actually wanted to mention something in the report caught my eye. Difficult decisions coming when it comes to corporate staffing levels. Sounds like layoffs are ahead, although they are opening new stores in 2023. A lot to digest. Like always with McDonald's. Let's get you up to speed now on the tech industry. The wave of layoffs continuing. Yeah, McDonald's.
I liked it.
Digestion joke. All right. Cheesy. Continuing now with PayPal joining the list. The company announcing it's letting go of 7% of its employees. You're now with what we can expect. We have the Allies. Ali Canal and Ali Garfinkel. I've been working on ideas, names like Alley-oop, I think is where I settled.
Ali Squared. I like alley-oop, though.
Ali Squared.
Alley-oop is rolls off the tongue a little bit.
Alley-oop I kind of like.
There's a simple elegance to it,
We can have a Twitter poll and we'll decide. Nice to have you both here in studio. We'll start with this, Ali, on the PayPal layoffs continuing throughout the tech sector.
Just another example of this trend that we continue to see. PayPal confirming that 7% reduction in staff, which translates to roughly 2,000 employees, and the cuts will take place over the coming weeks. Now, shares of PayPal did touch session highs on the heels of this news, climbing as much as 3.5%. Shares are currently up about 2% at the moment. But like I said, we've seen this story before, a surge in layoffs after a period of really high personnel spend, heavy investments during the pandemic. So that's trend number one surrounding this earnings season. And then trend number two is that unfavorable macro environment, a hawkish Fed, a pullback in spending, and probably most important heading into this week in particular, that advertising slowdown still very much in the background. We've heard from several companies that advertising is still an up and down story. Spotify saying this morning the ad market is still uncertain. And coupled with that, Cowen actually published a survey earlier this month that showed online ad buyers expect their spending in 2023 to rise just 3.3%, which is the softest ad growth outlook in 5 years. So for companies like Snap, companies like Google, whose businesses really rely on advertising, that ain't good. And that's just a trend that's weighing on earnings, weighing on guidance moving forward in the tech industry.
Yeah, it certainly has. And Allie, I know you're digging into the Snap results, what we're expecting to see here in just under an hour from now. That ad spending is going to be front and center here because we know last quarter it was pretty ugly when it came to Snap.
Yeah, it front and center doesn't even actually begin to describe it. When I was looking at Snap's figures, something became really clear to me, and it's that Snap's revenue is ad revenue. Here are some staggering numbers for you guys. In 2021, 2020, and 2019, advertising revenue accounted for between 99 and 98% of Snap's total revenue. So this time last year, Snap was describing its advertising business as seasonal and volatile. So the stakes are high, they're uncertain, and in the company's last earnings call, Snap is aware of this, right? In the company's last earnings call, CEO Evan Spiegel talked about needing to diversify, needing to have other sources of revenue. However, we'll see if they can actually do that. In that earnings call, what he talked about was efficiency, ROI. What he said essentially was, to achieve this, we're investing in driving scalable, lower funnel performance for our advertising partners and making improvements to our ad platform. So in about an hour less now, we'll see if they've started to deliver on that. Second thing to remember is TikTok. We've talked about on this show quite a bit. Analysts are really worried about the competition from TikTok. Yeah. And I think I wouldn't count them out, despite all the talk about bans, I wouldn't count them out by any means at all as a competitor to Snap, because the reality is Gen Z is TikTok's demographic, Gen Z is Snap's demographic.
No question. Here's where the alley-oop comes in. She puts it up in the air, you slam dunk
I got it.
and add to it.
I want to pick up on something you said, which is the word efficiency. And this is going to be the $1 million word on all of these earnings calls. On Spotify this morning, if I had a penny for every time CEO Daniel Ek said the word efficiency, probably have about a quarter. But that's where all of these tech companies are going towards, right? This growth at all cost strategy. It doesn't fly anymore on Wall Street. They had to spend a lot in order to keep up. They can't really do that anymore. They need to curve their expenses. And that's not just on the headcount front. I think they're looking at their products, they're looking at their brands, they're looking at everything within their companies to see where they could trim costs, because that's what they need to do amid this unfavorable environment. So that's something to look out for, I think.
And they certainly do need to cut costs. That's going to be in focus here with Snap. We know Snap was one of the early ones in terms of trimming their headcount so significantly. So I think analysts are asking whether or not more cuts are likely on the table and what exactly that will look like. Alley-oops. Thanks so much. I like it.
We can work on it.
I like it. Let's do it.
All right. Well, we are just getting started here on Yahoo Finance Live. Coming up, earnings have been the focus for investors this week, but that all changes tomorrow when the Fed makes its move on interest rates. Find out what answers investors want when Jerome Powell takes the stage. And Mazda unveiling its new flagship SUV, its first plug-in hybrid in the U.S. We'll have the details for you on that. And earnings from Snap, we were just talking about, and AMD on tap after the bell. We'll break those numbers for you as soon as they cross. Don't go anywhere.
The Federal Reserve is expected to announce it will continue hiking interest rates as Fed officials meet for their first policy meeting of 2023. Here's what you need to know. Economists widely expect the Fed to raise interest rates by a quarter point at this week's FOMC meeting, further slowing the pace of increases following a year of aggressive action to tame inflation.
They're telling us the intent is to take policy into a restrictive stance and then to hold there for an extended period of time.
But the battle against inflation is complicated, and the Fed walks a fine line between bringing down prices while also avoiding a major recession.
We do have weakness in a lot of data, but they're focused mostly on the labor market, and the job gains, while decelerating, have still been pretty resilient.
Although job growth has slowed in recent months, the unemployment rate remains at historic lows, coming in at just 3.5% in December. The latest inflation data has also shown some easing. The PCE index coming in at 4.4% in December, down from 4.7% the month before, though that's still much higher than the Fed's preferred 2% inflation target. The economy is beginning to show cracks in other areas as well. Consumer and business spending slowed in the fourth quarter, followed by weaker retail sales and recent layoffs across the tech sector. Fed officials will be weighing all of these factors as the central bank determines its interest rate policy, and investors will be watching closely for new insight into how much further rates will rise and any signs the Fed may pause in the near future.
Yeah, get your popcorn ready. Tomorrow, this time, we'll know 3 hours right here. The Fed, meanwhile, watching the tight labor market as it tries to get inflation under control. Wage growth up 4.6% since last year. That's about a full percentage point over where the Fed wants it. We'll get a new reading on wage growth this Friday with that jobs number. For more on where we're headed, we turn to Mona Mahajan, Edward Jones, Senior Investment Strategist. Nice to see you. What do you expect we will learn on Friday?
On Friday, which is the jobs report.
Yes.
That will actually be a very telling Friday. In fact, not only because we'll get, of course, a non-farm jobs number, which is expected to decelerate. Keep in mind, last month we were over 200,000 new jobs added. This month we're expected somewhere closer to 185,000. The unemployment rate, though, is expected to tick up, but only slightly, from 3.5% to 3.6%. Still near multi-decade lows. And then, as you mentioned, the key, at least for the Fed and for the inflation front, will be that wage growth number. Now, the expectations are actually for wage growth to be somewhat steady from last month at that 4.6, 4.7% year-on-year growth figure. What the Fed has told us, though, it would like to see that wage growth figure move closer to about 3.5%. That's more in line with about a 2% inflation rate in their mind. Now, keep in mind, this morning we did get interesting ECI, Employment Cost Index data. That also moderated down to about 1% quarter over quarter. That was below expectations, perhaps why we're seeing a bit of rally today as well. So we're looking for the unemployment rate. We're looking for certainly wage growth on Friday as well.
So one of them, what is, in terms of the data that we do have, because we've got the Fed decision tomorrow ahead of this jobs report, what does that signal just in terms of what you're expecting to hear tomorrow from Jerome Powell?
Yeah, you know, it's interesting. We're coming into this Fed meeting with a market that is in rally mode, essentially. The S&P 500's up 5%. Nasdaq's up closer to 10% in this 1 month period. Keep in mind, from a Fed perspective, they're not necessarily keen to see financial conditions easing and easing pretty substantially in this 1 month. So perhaps we'll get a little bit of pushback from Jerome Powell. He might reiterate, of course, his ongoing messages. They are not done raising rates. They perhaps have one more to go. And of course, they are nowhere near considering rate cuts. Now, keep in mind, markets are starting to price in rate cuts by year end. The Fed has been pretty consistent that they will keep rates at an elevated level, perhaps around this 5% range for some time. Now, we'd also expect Jerome Powell perhaps to comment a little bit on what they're seeing in terms of inflation trends. Last month or last meeting, they bucketed inflation into 3 categories: goods, housing, and then the services inflation. Now, goods is starting to roll over. Housing is showing signs of cooling. It's really the services component, which is driven by that labor wage growth that continues to remain elevated. So perhaps some color there would be interesting as well.
And the markets really don't believe the Fed is going to stay, believes it's going to cut in 23. Where are you on that?
Yeah, in our view, we think that it's likely that the Fed will start to at least signal rate cuts by year end, even if they don't execute them until early next year. And that's for a couple of reasons. One, if we do get an economic slowdown, that's one of their tools in the arsenal. But more broadly, at a 5% or so Fed funds rate, they're well above the neutral rate. And at some point, they will have to start thinking about bringing that, at least in small increments, back down to perhaps a neutral, which may be anywhere from 2.5%. So we think, barring any shocks in inflation and growth, they will probably start thinking about that and maybe signaling that by year end.
Well, we're starting to certainly see some cracks in the consumer retail sales following last 3 of the 4 reports that we've had. Certainly when you take a look at some of the other trends, housing market continuing to weaken a bit. What does this signal just in terms of the odds of a recession? Any hope that we could potentially avoid one?
Yeah, it's interesting. Our forward-looking indicators still point to a mild recession sometime, beginning in the first half of 2023. But, some of the trends that we're seeing, not only in the better inflation figures, the resilient labor market, but also, this ongoing resilience coming from Europe and the reopening in China, this has led to better outcomes across the board. So to us, whether we fall into an actual technical recession or a period of below trend or below potential growth, and potential growth in the U.S. is somewhere between 1.5% to 2%. We certainly think we could enter a period of softer growth. It will be tough for the markets to completely ignore this and power through. So we would expect some periods of volatility, but what we've been communicating is that period of volatility could in fact be an opportunity then to position for maybe a more sustainable rebound ahead.
All right, hope so. Mona Mahajan, great to see you. Thanks so much.
Thank you.
Coming up, we'll talk a little real estate with Redfin CEO Glenn Kelman, who says he thinks the U.S. housing market is showing signs of recovering. He tells us why after the break.
Home prices dropping for the fifth month in a row in November, according to Case-Shiller report out today. The latest sign that the housing market is still cooling off. But on a yearly basis, those prices are still up, climbing about 9.2% from 2021. Here with an inside look, we want to bring on the housing market. We want to bring in Glenn Kelman, the CEO of Redfin. Glenn, it's great to have you here. So let's step back a bit because mortgage rates have come back just a bit since peaking last year, right above 7%. The latest data that we've gotten on new home sales, on pending home sales, showing some sort of life. What's your assessment of the housing market today and any reasons to be optimistic?
Well, there are a few reasons for optimism. We're not out of the woods yet, but the market significantly improved in January. So Redfin, just to establish our credibility, called the top of the market on March 15th of 2022. We said that interest rates would bring the market down, but now we're seeing increased touring activity, more purchase applications, more offers being made over the past few weeks. It's still down from pandemic highs, but in November, we were off 35%. Now in January, we're only down 15 to 20%. So that's a significant improvement when you look at year-over-year numbers. And then the purchase applications for the week of January 20th were up, which was a surprise. Pending sales for December also up, a surprise. So it was a very weak market in Q4. It's significantly better now in January. Time will tell if rates are going to stay down.
And to your credit, and good to see you, Glenn, you called the top, so where's the bottom?
Well, we may have hit one bottom in November. That was definitely the nadir of the current market, but we could fall further if rates go up. Otherwise, there's still plenty of people who want to move to lower tax states, to more affordable parts of the country. So I think we need to see this housing boom over the past 2 years, not just as a fad, but perhaps unfinished business. There are still millennials coming of home buying age who want to buy a house. And if they can afford it, if rates stay down, I think we'll see some demand come back, not to the pandemic highs, which were crazy and unsustainable, but more to 4.5, 5 million units instead of the lows we saw in Q4, which were closer to an annualized rate of 4 million units.
What are your agents telling you in terms of increasing activity?
Well, some of our agents are seeing offer deadlines for the first time in agent-only listing remarks. We're starting to see bidding wars for really well-priced homes. It is still very hard to sell a condo in the urban core, but if you go out to the suburbs and you can find a house for under $500,000, those are in high demand. Investors used to bid for those properties and blow out our customers. The investors are mostly on the sideline right now, so people are starting to creep back into the market. There are a few places where we've seen 10, 20 offers on a home, which was absolutely out of the question in the fourth quarter.
Glenn, where are you seeing those bidding wars? Is it specific regions or is it strictly just housing price based?
Well, some of it is just that the seller has got to move and they've listed the property very low, but it is more popular in the suburbs. It is more popular for single family homes and under $500,000. That's the sweet spot. I wouldn't say it's the norm. It is still the exception, but it was absolutely unheard of 2 months ago. So to have the market come back at all is a real change. I have something in my throat. I can't help myself.
Go ahead, take a little cough. You got it?
Yeah, I'm ready.
So at what point, Glenn, do you think mortgage rates begin to flatten out? And is that enough to truly unthaw this market? Where will they bottom first?
Well, rates were up at 7 and now they're down to about 6. We're seeing some clients get a loan that starts with a 5% or a 5 on the rate. But rates can go back up very easily. There are very mixed signals on inflation right now. Your previous guest was just talking about what the Fed is going to do over the next 24 hours. So we're all sitting here going, trying to figure out whether it's going to go up or down.
Glenn, an interesting story in CNN Money yesterday about agents across the country using GPT for various functions, including writing their listings, even legal documents. Have you seen that trend among your agents?
We have. So some of our agents are using this technology to follow up with customers. Not all the people who go into real estate are William Shakespeare, and so they struggle with just composing an email that's grammatically correct. And if you give ChatGPT just a few facts about what's going on with this customer, you get a nice email on the other side. So I think ChatGPT is going to change online marketing just generally. More people are going to use it to create content when they're not good writers themselves. They're just like my 5th grader who's trying to figure out how to get a term paper done.
I was going to say, is that your 5th grader? Who's in the pictures behind you?
Yeah, that's one of them. That's one of them.
There we go. We love it. We love it. Glenn, it was great to have you on the show. We hope you come back. Glenn Kelman, CEO of Redfin. Thanks so much.
Thanks for having me.
A+ Zoom background. Well
Awesome.
done.
The best Zoom background we've had in a long, long time, maybe even ever. All right. Well, coming up, Peloton shares are on the rise. We'll tell you what has investors snapping up the stock after the break. Time for a triple play. Three stocks that we're watching in the final 30 minutes of trading. We have Lucid, Exxon, and Peloton. Starting it off with Lucid, it's the top trending ticker on Yahoo Finance. Morgan Stanley's Adam Jonas making the case that Lucid's stock is heading lower and that the fundamental outlook is, quote, more likely deteriorating than improving. One thing that has Jonas worried is Tesla's price cuts. He's saying that's because he thinks it could lead to a drop in Lucid reservations. And that's not all. Demand for its high-priced cars, that could suffer given the current economic environment and the rising rate environment right now. Fed's expected to raise rates again tomorrow. Now, when it comes to Lucid's relationship with Saudi Arabia's public investment fund, Jonas noted that the relationship between the two could, quote, extend beyond a controlling shareholder status, and that guidance and support from Saudi Arabia will, quote, potentially enhance Lucid's long-term infrastructure and supply chain development. Now, Ines, he does have an underweight rating on the stock, thinking it could fall substantially further than it is today. And of course, this is contrary to kind of the rally that we saw in Lucid following that report about the fact that Saudi Arabia could potentially buy out the remaining stake in Lucid. So I think there's big question marks out on the street just in terms of what this company is going to look like over the next couple of quarters.
Yeah, and how much they'll be able to produce going forward. But also that rally that you mentioned, I had reached out to an analyst that talked about the short interest on the stock that was over 20% short interest. So you were seeing a huge short squeeze with that headline. He said it's a really dangerous time to be in electric vehicle stocks right now. Taking a look also at XOM, that's ExxonMobil, after a record full year profit, $56 billion quarters. And last quarter, ExxonMobil beat earnings expectations for the 9th time in 10 quarters. Much was made of Chevron's buyback program of $75 billion that was announced last week. Well, ExxonMobil is holding firm with its repurchase program. Their buyback plan was announced in December 2022 of $50 billion. Dividends are staying the same at 91 cents per share. That's initially why you saw the stock lower this morning, but now it is higher. And look, these oil companies have had to really contend to both things. One is being able to give cash back to shareholders. On the other hand, also attending to the criticism from the White House and the like, with the White House also putting out a statement saying that it's outrageous that Exxon posted record profits when Americans were paying so much money for such high prices at the pump, because the administration wants them to produce more in order to bring down the price of oil.
Yeah, they add to that, clear that oil companies have everything they need, including record profits and thousands of unused but approved permits to increase production. But production domestically is on the increase, and it's at or near pre-pandemic all-time highs. So it's a difficult argument to make when you campaigned on ending the fossil fuel industry, while you embraced New York and California for phasing out gas-powered vehicles by 2030. This is an impressive needle to thread by the White House, isn't it?
It's very, very much so. I mean, this is the whole argument, is why would you invest if you know that what you're investing in is going to be obsolete? Right.
Yeah, and gas prices, meanwhile, creeping back up 5 straight weeks. Good stuff. My play, pandemic darling Peloton. The company pedaled so hard it sweated off more than half their market cap last year. But they've attacked the hill climb this year. I got Shauna with that one. Shares up nearly 60% this year. Multiple companies, meanwhile, reportedly eyeing an acquisition of Peloton, which would have cost $50 billion at their peak, but now riding through a bit of a valley below $5 billion in terms of market cap. Blackwell Capital, one of the company's largest investors, suggested a few names in a recent letter to the company, writing Apple, Disney, Sony, Nike, plus any number of tech, streaming, metaverse, and sportswear companies might get Peloton back towards the front of the pack. While neither has commented publicly, Amazon and Nike are both reportedly interested here. Peloton will report results tomorrow, and ahead of that release, revenue estimates have been downward revised 22 times, just once upward. And look at the stock. A huge jump up today, not necessarily on this report, just ahead of earnings tomorrow. I want to throw in a name. I'm not a large investor, an investor at all. I think Netflix ought to be considered here, because they internally talk a lot about wanting people on the platform more regularly. This is not about streaming a series, but they want people on it each day. And there aren't many things to do that. That's why I think this makes sense for Netflix.
You know, that is a compelling story there. And I'm not sold, but I think it's interesting. And I wouldn't count it out when you talk about the content
say that's
play.
A heck no.
I think it's far-fetched, but I do think maybe there is some sort of possibility there in terms of the most likely, I think, if Peloton were to get bought, I would have to go with Amazon. Given that partnership that we've already seen from Peloton, it does certainly seem to be paying off a bit when you take a look at their subscriber numbers, what we're expected to see tomorrow morning when they do report. Subs are expected to be added there, although it might be slightly below the street's expectations. But Peloton needs to do something to diversify their business, to get some of that momentum back that they have lost pretty significantly since peak pandemic times.
My bet is on Apple. Hardware.
Yeah.
And they certainly have the money for it.
Apple and Amazon have the most cash and a ton of content needs as well, certainly. Inez, thank you. Coming up, when it comes to cars, it's all about pricing. The head of Mazda North America tells us how his company is pricing its new plug-in hybrid SUV. There he is, after the break. The auto industry is on notice. After Tesla announced that it would be lowering its prices for its electric vehicles, Ford quickly followed suit with its Mustang Mach-E. Our next guest, his company raised prices in 2022, but with a new EV strategy that may change this year. Mazda North America President and CEO Jeff Guyton joins us now alongside Yahoo Finance Senior Autos reporter Praz Subramanian. Jeff, good to see you, sir. Your average price point hit an average of over $49K last December. What is Mazda doing to stay competitive? Do you have to lower prices?
Well, I don't know about that, but we are introducing right now the biggest and most powerful vehicle that Mazda has ever built and sold commercially with our CX-90. And we're taking an important step forward into the electrification journey that the industry is on.
Hey, Jeff, Praz here. So that new CX-90, we just saw that right now on our screen here. Tell us why it's so important for the brand and how do you plan to electrify this product?
So CX-90 launches with our most powerful engine ever in both gasoline mild hybrid and also plug-in hybrid forms. So the platform has only electrified powertrains, and it really represents a big step forward in terms of the premiumness of the Mazda brand. And we're bringing that together with a premium experience in our new Retail Evolution showrooms across the country.
So Jeff, I know that CX-90 has a new platform there, rear-wheel drive biased, more sporty and things like that, things of what Mazda is known for. But was there any thought of making this a fully electric vehicle, like a battery EV?
Yes, but what we see happening right now is that customers are obviously quite interested in the journey of electrification, but there are also inhibiting factors because the customer experience for electric is, let's say it has growing pains right now. And so whether you're talking about charging or cold weather or hot weather or electricity in California in the summertime and so forth. So what we see is that the plug-in hybrid model of CX-90 really can address people's interest in electrification. They can do their daily driving on electric. They can charge at home because most of these customers will have the ability to charge at home or at work. And then for longer trips and so forth, they don't have to face a range anxiety of any sort.
Jeff, it sounds as though you think others are throwing all their eggs in the EV basket a little bit too soon, that the demand isn't quite there. Is that what you're seeing out there in the marketplace?
I think there's a lot of demand, there's a lot of interest, but the technology and the scenery around it in terms of charging and so forth is not really mature yet. So we think that the customer experience right now suffers a bit, and that our formula can provide something more timely.
Yeah, how far away are we from having the infrastructure needed?
I think we're quite a ways off. And in addition to the infrastructure, nobody really understands quite yet how much supply there's going to be of rare earths and other materials we need for electric vehicles.
Hey, Jeff, so 2022 rounded off with a strong Q4 for you guys. 2022 overall, not that great, but kind of building momentum. Is that what you guys are seeing in 2023 as we enter in January? And then also, are you guys seeing some sort of macro kind of headwinds, demand concerns coming up?
So just on 2022, it was our best market share in 20 years. And it was nearly 300,000 sales for us, which was pretty good. But going forward into 23, clearly there are some headwinds for the industry in terms of interest rates and other things. But actually, I think there's probably still slightly more demand than supply.
All right, CEO and President of Mazda USA, Jeff Guyton, and Praz Subramanian, appreciate you both. Thanks so much. Coming up, pay transparency is a big issue in the business world, but now it's a hot button topic in the world of dating. And as you might imagine, I have a lot to say about this. Don't go away. Pay transparency, it's here. 13 U.S. states and cities covering 1 in 4 workers in the United States, from New York to California and Colorado, now require employers share salary information. It's a step in the right direction, no matter how absurd these salary ranges might be. In one case, a Netflix range between $90,000 and $900,000 a year. A young TikToker even joined us recently, is making 6 figures, asking people how much they make. Gen Z once again leading that revolution. Listen.
Older generations are less likely to share their salaries or talk about money in general. Younger generations like Gen Z and millennials are way more likely to share.
And they're doing it dating. Salary transparency has come for dating, with 13% of couples discussing it within the first month of dating. And there's a clear line of delineation here. Making less than $30,000 a year is a deal breaker, according to Western and Southern Financial Group. Don't get me wrong, with inflation on everyday items, sky-high mortgage rates, housing prices, you name it, living on $30K ain't easy. But this guy made half that. This dork right here made $15,000 a year at KEVN in Rapid City, South Dakota, when I began dating my now wife. While she deserves a ton of credit for eating ramen noodles and PB&J for the first few years, she, like most investors watching this show right now, was looking to buy low, believing this stock would go up and up exponentially, and it has actually. Dating is hard. Finding somebody to enjoy spending your life with is a real life mission impossible. Nearly a third of couples wish they'd discussed salary earlier in the relationship. So while transparency is important, the key is doing your homework. If financial goals go hand in hand with whom you want to grow old with, eye that person like an investment. Shauna, look at where the stock is going, not where it is now. You would never buy a stock based on, oh, that's where it's going to stay forever. You're looking for where it's going. Am I wrong?
No, I think you're exactly right. I do agree with you. I was hoping I was going to disagree with you, but I do agree with you. You're spot on, just in terms of, you don't want to sell anybody short. $30,000 a year, yes, it might not be what you're hoping to achieve during a lifetime, or what you're hoping your salary is going to be 10, 15, 20 years down the line. You got to take a chance on that person. But speaking of things that people might now be starting to discuss more, or maybe more so wish they had discussed more, you mentioned that salary figure, also debt in general, just in terms of how much debt many people are racking up at this point. 63% said that they never discussed debt in their relationship. Millennials say that credit card debt is the biggest deal breaker. When you take a look at the numbers, about 2/3 of millennials have credit card debt. So if that's your deal breaker, you got to start talking about it. I think the key to all this is just communication.
No question about it. There should be more of that. Personal loans was the biggest deal breaker when it comes to both men and women. And though one's from Mars, one's from Phoenix, 31% of men and women said personal loans were the #1 deal breaker when they found out about them. My wife did have personal loans, which I found out about early. I'm going to put you on the spot here.
Yes.
If your husband made 15 grand when you began dating, would you still have been dating?
Of course.
Okay, good answer.
Of course. It would have been tough. We both lived in New York at the time. $15,000, I think we would have had to move. But yes, of course.
And we should point out, as our TikTok friend did there, not just with pay transparency, but with dating, it is Gen Z that's really beginning to change this and begin to have that conversation earlier. Really interesting study. We'll link that on Twitter.
All right, well, coming up here next, we are counting down to the closing bell on Wall Street, looking at gains across the board. We'll be right back.
All right, just a couple of minutes away from the closing bell, so let's bring in Yahoo Finance's Jared Blickery to break down the market action. What are we seeing, sir?
Dave, look at all this green. How happy can we be? Nasdaq leading the way up 1.5. Dow is lagging, but it's still up over 1%. The Russell 2000, look at the small caps. They are up 2.4%. And time now to delve into some of our tickers. And guess what? Artificial intelligence has been on the rise. And here we go. Intriguing investors today as well, bidding C3 AI. It's up nearly 20%. Second best day ever. And this is as it looks to cash in, guess what, on the AI craze. And this is, they have a new product that's helping workers locate data in the Byzantine world of corporate enterprise information systems. Think ChatGPT for your business. Now, overall, it's been a crazy week for AI. So let's take a look at this screen right here. We know AI is up 22%, but how about BuzzFeed? That was a ticker that was in the news just a couple days ago, up an amazing few hundred% there. Now, we got to switch over to the streaming world, and let me just get our screen here, because Roku is in the news, and they have a new partnership, guess what, with Warner Bros. Discovery. And they're combining Warner's premium selection of fast channels to the Roku channel. And it's coming this spring. Viewers are going to have access to 2,000 hours of on-demand TV, hundreds of titles to choose from, along with movies from HBO and Discovery. Now, we can see Roku over the last year still firmly entrenched in the bottom end of this range, one of those disruption stocks we all know and love. But I'll tell you what, check out what's happened over the last couple months here, and we'll see if I can get that chart up of a 2-day. There we go, 2 months, and we see that Roku is up a whopping, it's down 2.9%. Not all of these end well. So we got to go to Caterpillar here, and for that I'm going to find our industrial screen, and might as well pull up the Dow Jones Industrial Average, because this is a read on the economy. Now, Caterpillar is putting its worst day in since September, and we might be measuring a slight fever here if we're trying to take its temperature. That's because Caterpillar missing on profits for the first time since the pandemic, and the company is struggling with higher input costs and supply chain issues, but the company has high hopes for its sales of its signature yellow-orange heavy-duty construction and mining machines. And this is thanks to favorable prices and a competitive cost environment. So here's Caterpillar up 6.9% today, 25% for the year. And look at this nice breakout right here. A number of industrial stocks that slumped or at least traded sideways last year are starting to break out. So something really to watch, keep an eye on. Now let's take a look at the NASDAQ. We got a few seconds left here. The left side of the board not looking as good as the right, and that would mean the mega caps feeling some heat. That's over the last 2 months. But in today's price action, we have Amazon up 2.5%, Tesla up almost 4%, Microsoft up 2%, and the list goes on here. And since we're talking about chip stocks, might as well take a look at our chip board with AMD up 3.5%. And with that, I'm going to send you guys on to the closing bell here.
All right, that wraps up the trading day and the month of January. We're looking at gains across the board, not only for the day, but also the month. Taking a look at the Dow up today, 369 points. S&P up just about 1.5%. The Nasdaq, the outperformer for the day, also the outperformer for the month of January, closing the month up just over 10%. The S&P up well over 5%, the best January that we've seen since 2019. Let's take a look at some of today's big movers here. It's all about earnings. We got to start with Spotify, because look at that jump. Shares popping nearly 13%. It's the biggest one-day pop that we've seen in this stock in just about a year. Now, the move coming on the back of the company's fourth quarter earnings report. Spotify co-founder and CEO Daniel Ek was very upbeat on the earnings call, making the case for how Spotify is reimagining its spending moving forward.
We will continue to work to build the platform of the future, and that will take investment in new opportunities that we outlined, like podcasts and audiobooks. And if anything, thanks to our position in users and subs, this should allow us to both increase revenue per user over time, as well as improve our stickiness with consumers even more. But going forward, we will do it with an intense focus on efficiency. And that marks a pretty big shift in how we will act.
Efficiency certainly was a theme on that earnings call, Dave, and it looks like the street really cheering on what they heard from Ek, what they saw in these results, with the stock up 12.7% today.
God, the numbers are insane. 489 million monthly active users. That is up 20% year over year. 205 million paid subscribers. That's up 14%. And ad revenue's up 14%. Not much to dislike about this report. And going back to when they reduced headcount, also a positive for investors. They cut 6% of their workforce. And right after that was reported, Daniel Ek in an internal memo said he was too ambitious in investing ahead of our revenue growth. Let's go back in time. $200 million for the Joe Rogan Experience. They had a couple of other acquisitions that they paid too much for as well. Gimlet Media, Parcast, The Ringer. So clearly less M&A activity, better for investors. Hard to ignore the massive growth they're seeing there.
Yeah, very hard to ignore. We know the emphasis is going to be on that margin progress. Wells Fargo saying that this year is going to be a pivotal year for that, and that is something that investors are going to continue to focus on.
All right, and we're going to focus on UPS. Shares closing higher despite the company missing the street's revenue estimates by more than $1 billion. You can see 4.6% gain on the day. UPS projecting full year revenue for 2023 between 97 and 99 billion, 0.4 billion, just shy of the street's estimates. UPS CFO Brian Newman saying on Thursday's earnings call, quote, "We expect 2023 to be a bumpy year. Headwinds that will impact the business, including record high inflation, recession fears, a war in Eastern Europe, COVID disruptions in China, and U.S. labor negotiations." Still, shares of UPS edging higher today as the company projects some of those concerns to subside in the second half of the year. So again, just reiterating, they see a recession first half, a recovery in the economy and in their business in the second half.
Yeah, you got to look at this package volumes here. It's a little bit concerning when you take a look at the broader economy, what that could signal, at least for the coming quarters. We know that the holiday period is so important for UPS, so important for its rival FedEx. And when you see that package volume drop, coming up a bit short, rather, I should say, consumers really pulling back on their spending, what exactly the signals here for the next quarter or two could be something to really keep an eye on. And then also labor negotiations. We know that's going to be front and center for UPS over the next couple of quarters. Those negotiations are expected to start in April. Of course, how that pans out could have real implications for UPS.
Yeah, some feel this will be the most contentious labor talks they've had since the strike in 1997. They're dealing with the Teamsters. This is going to be a real tough road, and it's going to cost them a pretty penny. They did increase shipping prices 6.9%. That's on top of the 5.9 the prior year and 4.9 prior to that. So not a great story in terms of inflation coming down, because they are continuing to increase prices there at UPS.
Yeah, they certainly are. When you take a look at that price increase, it's also going to be a question of whether or not consumers are willing to spend, how much they will be shipping, whether or not that, of course, is going to impact their behavior down the line. Certainly something to watch.
All right, another ticker trending on Yahoo Finance today, Carvana. Gotta love it. Shares opened the day higher before pairing gains later in the trading day. Once again, rising this question. Is the car vending machine company due for a turnaround story, or is it just the latest target for meme stock traders? Here to talk about that is Douglas Arthur, Huber Research Partners Managing Director. Hello, sir. Good to see you. Why in the world is this stock up 118% this year?
You got me. It's a good question. I mean, obviously, it was down 94% in 2022, and I think the correlation between stocks that got pounded, particularly in the second half of 2022, and have had a massive rebound on very little news in early 2023 is high. And Carvana fell the most, and it's had the biggest increase off a very depressed bottom in 2023. I mean, in early 2022, the stock was around 300 or so, or late 2021, and then it fell to under $5 at the end of 2022, and so it's doubled to 10. You know, I don't really read much into it.
So, Doug, certainly totally at odds with the fundamentals of this company. What is the future of Carvana? Lots of talk about the risk of bankruptcy. How likely do you think that is?
I think it's pretty likely. I mean, I think, they got themselves, they were in trouble before they went out and raised $3.3 billion of debt in the first half of 2022 to buy Odessa. $2.2 billion of that was to buy the company, and $1 billion of it was to finance the expansion of it. They've got the cash, for the expansion still sitting on the balance sheet. So that's probably keeping them afloat right now. But bear in mind, I mean, based on my fourth quarter expectations, I expect them to lose $2 billion in 2022 on the bottom line. So that cash is not going to last for long. And the equity market is largely shut off, and the bond market is largely shut off. So where's the money going to come from if they run out of money?
According to data from S3 Partners, about 66% of Carvana's free float held short. Is there anything, and this feels a lot like a Bed Bath & Beyond story, is there anything they could do, in your estimation, to turn around the fundamentals of this company in their future?
Well, Ernie Garcia, the CEO, said on the third quarter conference call, they've got, 50 working groups at the company addressing costs and efficiencies and logistics and trying to bring down their costs. So I do expect to see a better cost performance in the fourth quarter than the third quarter. Now, the problem with any online company is marketing is your biggest cost. You've got to continue to market or consumers forget you exist, right? You don't have storefronts that people are driving by. You have the vending machines, but there aren't that many of them. So, I mean, when I watch late night cable news, there's still a lot of Carvana advertising. So how much can they bring costs down while their, gross profits are being squeezed? That's a tough question for them.
Doug, taking a look at Carvana, the innovation that, of course, the company did bring, the first mover here into the online used car market. Is this something potentially of a partnership or a potential takeover that you think maybe could be out there as a potential possibility?
100%. And that's why, I've had a low price target all year. I've had a sell in the company since I initiated back in 2019. Obviously, stock went to almost 400 and now it's back to earth. But I said in my latest piece, I wasn't going to a zero target price because I felt a partnership was likely. They have innovated. They were a first mover in the online used car business. That's got to be of value to somebody. A bigger company could refinance their debt, which is onerous right now. So I do think that's possible if the Garcias, dad and son, are willing to give up control or some control. And that's another thorny question.
Douglas, taking a look, just stepping back here, as an analyst covering a stock that's trading right now so detached from the fundamentals of the business, does that complicate? How much does that complicate your coverage of the stock?
It complicates it, but I pay attention to the bonds, right? So they issued 10 1/4 bonds last year to finance Odessa. Apollo bought about half of them. Where are they trading? They're trading at 55 cents on the dollar, 10 1/4. So what does that tell you about, the bond market, I think, is being much more disciplined than the stock market, which has got a lot of retail activity, a lot of short covering. It's kind of crazy to watch. I don't think you can take any of it too seriously.
Is there a real estate play for a GM or a Ford that's looking to expand their footprint?
They have value in the real estate of the Odessa facilities. They are starting to do sale leasebacks on that. To me, the partnership opportunity is they have created a business. They were a first mover. A lot of the traditional, brick and mortars have tried to emulate what Carvana's done. So they have that brand value and consumers know them. So could a bigger company take them over or buy a substantial portion of them and give them breathing room and benefit from their technological expertise? And I think the answer to that is unknown, but a possibility.
All right, Douglas Arthur, great to have you. Thanks so much for joining us here. I think we're all scratching our heads trying to make sense of the Carvana story right now. Certainly shares have been on a wild ride over the last 12 months. Certainly has been a wild time over the last month or so. Snap earnings right now, the stock off just about 13.5%. Looks like Jared Blickery has those numbers for us. Hey, Jared.
Hey there. Let me just get you the headline numbers. We're going to be digging through this report here. Fourth quarter results, adjusted EPS. That came in at 73 cents when the estimate was 70 cents. So that was a beat. But revenue, net revenue coming in a little bit light, that was actually a beat as well. 8.7 billion versus the estimate of 8.32 billion. Now, adjusted gross margin is what came in a little bit light at 36%. The estimate was 36.7%. And also the adjusted operating margin, well, that was a little bit better than expected, 15% versus 14.6%. And just looking for some of those key metrics that we look for with respect to some of these numbers. I'm sorry, it looks like I'm not actually reading the numbers for this report that I was supposed to. I'm afraid I can't find these numbers right now, so I'm going to have to.
Jared, I got him here.
You,
so I'm looking at the numbers crossing right now. So daily active users, 375 million, it looks like, for Snap. Adjusted EPS of 14 cents. The estimate out there in the street was 11 cents. Revenue coming in just shy of expectations, essentially in line with what the street was looking for. Fourth quarter revenue of 1.30 billion. The estimate in the street was for 1.31 billion here. Daily active users, that number I mentioned there at the top, 375 million. That's up 17%. We know that was a number that the street was going to be closely watching. That revenue number for the first quarter, in terms of their outlook here, they see first quarter revenue falling 7% year over year. That could be a disappointment here for the stock. Internal forecast assuming that first quarter revenue would fall anywhere between 10% to 2% on a year over year basis. So again, the daily active number user right there, 375 million, up 17%. That, I think, will be looked at as a strong.
But it's not, right? Yeah. It's not by investors. This stock is down 13.5% after hours. You equate that almost, Shauna, and I could be wrong. You remember for so long, Netflix was purely a subs play, and that's what the stock rose and fall on. And now we've seen twice in a row, Snap has put up really impressive growth in terms of their daily active users, and the stock has plummeted. People just don't care about the daily active users the way they used to. At least that is one interpretation based on the performance of the stock after hours.
Yeah, and I also think the fact that I think the real story here is estimates have come down so much in terms of what we are seeing this quarter. So a report where revenue essentially is in line with expectations. The guidance, I think, is the big story here. When you take into account that they're expecting revenue to fall in the first quarter, that is something that the street is really focusing on in this report. And then, of course, the competition that's out there for Snap. We talk about more and more of their user base spending time on TikTok, spending time on Instagram, on Reels. That, of course, is eroding some of that engagement, which is really critical to Snap's business. That ad spending, clearly a weak spot in this report, and an environment that might not improve now for just a bit. Well, Snap isn't the only company reporting earnings this afternoon. We're going to have AMD's fourth quarter results after the break.
All right, another earnings alert here. Chipmaker AMD out with earnings. Our Inez Ferre has been cranking out, and she's got the data for us. What are you seeing?
Yeah, and it looks like a beat definitely with AMD's fourth quarter revenue coming in at, well, just shy of expectations, $5.6 billion. The estimate was for $5.2 billion in revenue. It's seeing its first quarter revenue coming in between $5 and $5.6 billion, and the estimate was for $5.6 billion in revenue. What's interesting is the commentary that was said in their earnings report saying 2022 was a strong year for AMD. We delivered best-in-class growth and record revenue despite the weak PC environment in the second half of the year. That's according to Chair and CEO Dr. Lisa Su. Also saying, although the demand environment is mixed, we are confident in our ability to gain market share in 2023 and deliver long-term growth based on our differentiated product portfolio. Their adjusted earnings per share for the quarter came in at 69 cents. The estimate was for 66 cents. So that's a beat. But this guidance from what they're talking about in this earnings release, this is important. It's relatively bullish because what the street was looking for was positive guidance going forward. Because if AMD, which has been taking market share away from Intel, if their guidance is not as great, then that would signify something bigger, a bigger problem for the industry that we know that the chip industry has been in a downturn recently.
Yeah, certainly a huge downturn there. But again, that stock popping after hours up 3.5%. Inez, thanks so much. Let's take a look at Snap because it's a huge mover here this afternoon in extended trading. Shares under pressure following its fourth quarter results that we just got out. The shares off just about 14% right now. A lot of that pressure, almost all of it, has to do with its guidance that we're getting for the first quarter. Growth expected to slow. They're actually expecting their first ever quarterly revenue decline for the first quarter. They're expecting revenue to drop within the range of between 2% to 10%. That's on a year-over-year basis. We're seeing Meta, Pinterest, Alphabet, some of those other names in the social media space lower here on the heels of these results from Snap. Daily active users coming in just above expectations, 375 million. The estimate in the street was for 374.7 million. Adjusted EPS also better than expected at 14 cents. Revenue essentially in line with the street's forecast. Revenue for the fourth quarter coming in at 1.30 billion. Estimate out there was for 1.31 billion. All right, well, coming up, we will dig deeper into Snap and AMD's fourth quarter earnings. Stick with us. Snap shares off just about 13.5% following its fourth quarter results. They're guiding for their first ever quarterly revenue decline for the current quarter, for the first quarter, expecting revenue to drop 2 to 10% on a year-over-year basis. For the fourth quarter, adjusted EPS coming in at 14 cents, revenue essentially in line at $1.3 billion. Here to talk about it, we want to bring in Scott Kessler, Third Bridge Global Sector Lead for Technology, Media, and Telecom. Scott, it's great to have you here. So I know you've only had a few minutes to dig into this report, but what's your first takeaway?
I mean, the first takeaway is the company seemed to have met expectations for Q4, but they did signal that the first quarter has started off slowly, and they, I think, indicated that essentially year-to-date revenues are down 7% in the first quarter. That, if it continued, would translate, as you pointed out, to not only a decline in revenues for the first quarter, but I think importantly, significantly below expectations, which were for an increase actually in revenues in Q1.
What's your reaction to adding 56 million daily active users, up 17%?
Yeah, I mean, look, I think that number is fine. I think the numbers that they reported for Q4 are going to largely be seen as in line, acceptable, or otherwise okay. I think the issue is, of course, the continuing deterioration when it comes to the top line. And I think people probably are going to want some answers. I think initially, Snap was really one of the first companies to signal that global economic uncertainties or weakness or an impending recession were going to adversely impact the company's business. They took a number of actions. I think they pre-announced, they missed guidance, they announced a major restructuring, they laid people off. There are a lot of things that they did. One of the things that they clearly need to do is be able to pivot the business from an advertising model focused on big advertisers and brand advertising to something more oriented around performance advertising. That's not something you can do over the course of a couple of quarters.
Yeah, how long does that type of transition take, Scott?
I mean, clearly we're seeing that it takes quite a bit of time, and it's not simply just their capability to accept that kind of advertising on the platform, but whether or not advertisers want to use Snapchat as a vehicle for that type of promotional activity. Historically, they've looked elsewhere for that. And when they see some of the kind of operational and fundamental underpinnings of the company and the performance, I think they're inclined perhaps to look elsewhere.
Scott, is this a Snap-specific story, or because of this warning, because of the lack of revenue growth, or really the deceleration that they're expecting to see in the first quarter? What does that signal to some of the larger companies that we're going to get in the next couple of weeks?
So I think you can look at it in a couple of ways. On one hand, you can say, was Snap a canary in the coal mine, if you will, right? So they signaled that what was going on in the broader economy was hitting it harder and faster than other companies. And then eventually other companies kind of indicated, hey, this is a problem for us as well. Or do you go back to the narrative that a lot of people were sticking to kind of in the spring and summer, saying that Snap was more of an outlier, given the fact that it tends to have a different type of advertiser and a different type of advertising on the platform. It remains to be seen, but I think it's fair to say that at least the indications about the Q1 revenues would suggest that times remain tough for Snap, and they're going to have to take some further actions to kind of address some of these issues unless suddenly global economies kind of firm up and snap back.
Third straight quarter, they declined to provide a forecast. They laid off 20% back in August. What do you want to hear on the call? Is it further layoffs?
Not necessarily. I think probably what a lot of people are looking to get insight into as to why exactly we're seeing kind of the revenue picture painted the way it appears to be at this point. And if in fact there's a sense that there could be kind of, stabilization and improvement over, say, the second 2 months of the quarter. That's what people want a sense of. I know the company seemed pretty clear about saying they're not providing guidance for Q1, but I think they're going to want a little bit more than that if they're going to remain at all kind of confident in what this company is going to be able to deliver. And frankly, that's one of the biggest problems that Snap has had over the last couple of quarters. Is it seems like starting in the spring, they really started to lose investor confidence because of their inability seemingly to gauge and forecast and communicate about the performance of the company for months in a row.
Stock down about 14%. Scott Kessler, thanks so much. Appreciate that. All right, for more on AMD's latest earnings report, Chris Rowland, Susquehanna International Group Senior Equity Analyst, joining us now. Good to see you, sir. Interesting report. Looks like a rough guidance, but a pretty solid beat on the top and the bottom. Your initial reaction, Chris?
Yeah, I think Intel set an incredibly low bar. And while this was not a perfect report, it probably hurdled that low bar for sentiment.
Chris, what do you make of the client segment just in terms of revenue here? Because it missed $903 million. The expectation on the street was for $995.5 million. Clearly, the cooling PC market having an impact on that segment. How weak, or is this the weakest you think that segment's going to get?
That was actually a little bit better than we had expected. We were probably the bear on the street around this segment. In PC right now, Intel has essentially stuffed the channel full of PC inventory. And so this actually is a result that we think is a best case for AMD as they work through all of this inventory throughout the channel. We think there's multiple billions of dollars of CPU inventory that needs to be worked through.
They offered some commentary that demand was mixed, but they project gaining market share in 2023. Do you agree with that assessment?
I do. I think they have a new revamped GPU lineup that will better compete with NVIDIA this year. So I do see some great gaming potential here.
Chris, what about the data center business? Because unlike Intel, we've really seen AMD's data center business grow a little bit. Taking a look at these numbers, actually came in slightly better than what the street was looking for at $1.66 billion. What do you make of that report, that number?
Yeah, so we think this is just the start for them in gaming. They have a new CPU chip called the Genoa, which will be going head-to-head with Intel's Sapphire Rapids. We think it has as much as a 50% performance beat over Intel. And so we expect AMD to not only benefit from better ASPs, server ASPs, but also taking a ton of share here for probably the next 2 years.
Some tailwinds and some headwinds when it comes to the Biden administration. We'll start with the CHIPS Act, which should be a net positive, and then there's the chip restrictions in terms of what they send to China. How do those play into the future?
In terms of subsidies from things like the CHIPS Act, AMD is primarily manufactured out of Taiwan. They are third-party foundry manufacturing, and therefore they will not get anywhere close to the benefits that Intel will be getting from things like the CHIPS Act. In terms of Chinese restrictions, that's still a TBD. As of right now, general purpose processors are able to ship into China, and so we don't see this as of right now being a big issue.
Well, Chris, speaking of some of the weakness more broadly that we're seeing in this sector, we had Intel CEO Pat Gelsinger on Yahoo Finance last week following their week report. I want to play what he told us and then get your reaction.
Numbers that basically we haven't seen for the company for a decade, projecting losses that we haven't seen for 30 years. It's very difficult. And that's what we laid out for Q1. A very tough picture, but one that I'm confident that we'll navigate through and will make the company better as a result.
Chris, what needs to happen to get the environment, to get this picture much stronger when it comes to all of these chip makers?
All of the chip makers is a bigger discussion, but in terms of Intel itself, Intel needs to focus on process and products. They have a roadmap. They've laid out a roadmap. If they can hit those points in its roadmap, they will likely be able to compete with AMD and TSM over the long run. But if they cannot hit this roadmap, and if it slips like it has in the past few years, over the past 5 years, it's slipped incredibly. Intel is in a very, very difficult situation if they cannot hit those milestones in their roadmap.
Chris, biggest question you have for the call?
For AMD, I haven't seen some full year guidance, so I want to know about that. I want to know about the outlook. I want to know about the trajectory. I want to know about the recovery in client. I want to know if they're going to take share in PC. I know they'll take share in server, but is their expectation to take share in PC as well? These are the things that are most top of mind to me.
All right, the stock up nearly 4% here after hours. Chris Rollin, thanks so much. Well, coming up, some of the biggest tech names that have yet to report this week. We got Meta, Alphabet, Amazon, Apple, all on tap. We'll discuss what these companies will tell us about the broader market when we come back. Snap shares sinking off just about 13% in extended trading following a disappointing guidance number from the company as they kick off some of the big tech earnings that we have this week. Wall Street expecting certainly a rough quarter. We want to bring in Keith Lerner, Truist Co-Chief Investment Officer. Keith, it's great to see you here. So Snap disappointing on guidance on the heels of Microsoft offering lackluster guidance from that company as well. Your take on their earnings season so far, specifically what we've seen from tech?
Sure, and hey, great to be back with you, Shauna, for you and Dave. You know, I think earnings season, that the numbers actually haven't been that great. Overall, you're seeing the beat rates or the margin of the beat rates relatively low. But what's more important from a stock market perspective, the market is shaking it off. And the question set becomes, why is that? I think you came into this year, you had a sell-off in December, a 6% sell-off. I think expectations were really low, and that's why the markets are reacting even favorable. Not aside from Snap, in general this season, we're seeing stocks act somewhat favorable. But thinking about tech, I mean, the big numbers that really matter are going to be out later this week. I mean, on Thursday, we have Apple, Amazon. I think we have Meta maybe tomorrow. So those are going to be the big heavyweights that are going to matter more for the market. You know, overall, our position on tech, we're still somewhat skeptical that that's leadership for the market this year. They are oversold. They are being up. but we just think they've had such huge outperformance over the past decade that they're unlikely to be leadership in the next cycle.
Yeah, Google's up about 11% this year. Meta's up 20%. Amazon's up 20%. Even Peloton up nearly 60%. Is this trend built to last?
It's interesting, Dave. Just more specifically, what you just talked about, these big numbers, I think they should be put in context, because we did a study that we just published yesterday, and what we looked at is the bottom 50 stocks in the S&P were down an average of about 52% last year. Those same stocks, those same 50 stocks, are up an average of over 20% this year. And what's also interesting when we looked at the work is every single one of those bottom 50, every single stock is up. So what does that tell you? That tells us that there was a lot of tax loss selling, that these stocks were sold off hard at the end of the year. The calendar changes, the tax loss selling subsided, and there's been a kind of a mean reversion, and these stocks have bounced out. A lot of the ones you mentioned, another one like the ARK ETF, up 25% this year, but flat since December. So we think this is more of a mean reversion. But we don't think it's sustainable. We think it's kind of more of a, more reflective of an area that was just really beaten up. We just don't see that as more likely leadership, given we still think the economy is likely to weaken, and we're not going to have a lot of liquidity come in, which typically helps these type of stocks.
Well, Keith, do you think we're going to start seeing that reversal this earnings season? It certainly looks like that's what we're seeing with Snap here after hours.
Yeah, listen, what you're seeing on this earnings season is just more discriminate as far as you're getting hit 10%, but then you saw like today, GM reacted really well to earnings. You saw some of the industrials have really big days as well. So I think overall it's been mixed. I mean, we actually have a more favorable view going back to the industrials. Look at the defense sector today. That's on the cusp of a fresh absolute high, and also acting well on a relative basis, because they have some secular trends as far as defense spending, reshoring. So we'd rather stick with some of those areas where we think there's some unique aspects to this cycle, even though we still expect the economy to slow somewhat this year.
So when it comes to the big three, Apple, Amazon, Alphabet, if you were to put them together, what's the one question you want answered about all of them that'll give you a better direction?
Yeah. Well, I think the question for tech in general is, there was so much pull forward demand, right? And all the layoffs you're hearing from tech, I mean, that in context, it's nothing relative to how much they hired the last few years. So I guess the question is, where are we with that pull forward demand? What is the earnings growth outlook? Are they going to grow stronger than the overall market? Because the one reason you buy tech is you pay a premium for tech is they're growing faster than the overall market. Over the last year, that hasn't been the case. The earning trends, the earnings momentum has been much weaker. So I really think that's it. Have we kind of moved past that soft spot and start to see some reacceleration? And then lastly, also, businesses are cutting back on expenses. A lot of these big companies are, a lot of companies are looking at these bigger technology companies and just taking a little bit back from them. So I'd be curious to see, what they're seeing from the corporate spend as well.
Well, Keith, what are you expecting to see from Powell tomorrow? Because we know the rising rate environment obviously will be challenging here for a lot of those larger cap tech companies. Lots of questions about what exactly has been priced into the market up until this point. What do you think?
So I don't have much qualms with the way the market's pricing things right now, like another quarter point hike tomorrow, and then another quarter point maybe in March. But I think what he really needs to discuss, and what I'll be looking for, is how long are we going to keep rates higher? Because right now there's a disconnect between the market starting to anticipate some significant cuts by the end of the year, and Powell has been saying that that they're going to keep them higher for longer, and that's our call as well, because we think there's scar tissue of this inflation of last year. So I think he's going to talk about that. I mean, financial conditions, which they've talked about a lot, have eased quite a bit. So I don't expect him to talk overly soft about as far as things. I think he'll be a little bit still somewhat hawkish, and maybe change the tone about the length of before they actually go ahead and cut rates.
But as for where Truist is, you see a 25, and a hold until 24.
Yeah, well, I think actually our baseline is by the end of the year we'll see likely one cut. The market is pricing more of that, and again, we think the response function from the Fed isn't going to be as quick as it has historically, where they would have been cutting quicker and deeper, because this is the first time in over a decade they've had to deal with inflation. So we think that scar tissue will have them leaving rates higher for longer. And I think he'll have this opportunity to reset that with the overall market tomorrow.
All right, Keith Lerner, Truist. Always a pleasure, sir. Thank you. Snap and AMD headline this afternoon's earnings slate, but other companies like Match are also generating plenty of buzz after hours. We'll break down the latest moves for you next.
Let's take a look at some of the trending after-hours tickers. We have 5 for you. Snap, AMD, Match, EA, and Amgen. Snap obviously under significant amount of pressure following their weak guidance for the current quarter. That stock off nearly 15%. AMD, they posted a beat on both the top and bottom lines. We're seeing that stock up nearly 3% in extended trading. Let's take a closer look at Snap. Shares off just about 7.5% here. A disappointing report from the company. Revenue and EPS both missing the street's expectations. Guidance, first quarter revenue guidance also coming up a bit short. So that's placing some pressure on Match Group. We're talking about Match Group right now, off just about 7%. Fourth quarter payers declining about 1% here. So it doesn't necessarily look like Match, the dating app, the dating scene, is recession proof. Looking at a 7% drop here in extended trading over the last 3 months. So we're still looking at gains of just about 25%. Let's take a look at EA, Electronic Arts here, off also just about 7.5% here in extended trading. Current quarter and full year net booking guidance coming up short. That, of course, is a big focal point here for the street, for investors when they're digging through this report here from EA. Also, another piece of bad news here. The new Star Wars game has been delayed to April, was initially expected to launch in March. We're looking at pressure on that stock here over the last 3 months. Didn't stray too far from the flat line, up just about 2%. And rounding it out with Amgen, that stock off just a fraction here in extended trading. EPS $4.09, beating by a penny. Revenue, though, ticking down to $6.84 billion. A 4% boost in product sales was offset by slowing sales of the manufacturing related to COVID-19. We're looking at losses of just about 6% in the last 3 months. Over the last 6 months, taking a look at a bit of a longer term chart, that stock is actually in positive territory, up just about 2%. Dave?
Okay, Shauna, thank you. Ritz crackers, Philadelphia cream cheese, Oreos. A few of my favorite products. Made by Mondelez. You can see shares popping a bit after hours after reporting their fourth quarter earnings beat. Yahoo Finance's Brooke DePalma here to break down the numbers. You gotta love Ritz crackers. If you don't, we're not friends.
Oh, we are certainly friends, Dave, because I love Ritz crackers, and it turns out investors do too.
Yeah.
Oreo maker Mondelez certainly beating on both the top and bottom line here as consumers look to their favorite chocolate treats and perhaps those Ritz crackers during inflation. As you can see here, they posted a beat, revenue coming in at $8.7 billion, adjusted earnings per share coming in at 73 cents, both higher than Wall Street's expectations, largely driven by pricing and volume. CEO saying that on the release today. As I noted before, consumers are hammered by their spending power, but they are still flocking to those known brands like Oreos, their favorite here. In addition to that, taking a closer look at full year revenue here, jumping across all markets. Latin America up nearly 30%, Asia, Middle East, and Africa up nearly 5%, Europe up 2.4%, North America up 16.6%. CEO noting that these results were underscored by the strength in emerging markets, largely Latin America there. In addition to that, they also did note that drivers of this past year, as well as the fourth quarter results, were based upon acquisitions of Cliff Bar, among other acquisitions, but they were offset by unfavorable currency that impacted across the board in 2022. In addition to that, they did note that they announced an agreement with Perfetti Von Malle to acquire our developed markets gum business. So, of course, they are makers behind Trident and Stride. Those gum businesses are in U.S., Canada, and Europe. That deal expected to close in the fourth quarter of 2023. Another announcement made on this earnings release is a $6 billion share buyback program that's expected to go through December of 2025. So lots to unpack as investors and Main Street certainly looked to this company for a sweet relief, I guess you could say, amid inflation.
Legendary airport purchase, the Toblerone.
Oh.
Cadbury's pretty good too. All right, what are analysts looking for on the call? What do they want to hear?
Yeah, well, I really think they do want to understand how exactly the consumer is responding during this time, largely looking as Easter is around the corner for that Cadbury purchases. Perhaps, are they responding to a higher price? Are they still going to flock to those favorite treats, especially upon the Easter season? I think in addition to that, they definitely want to hear more on just the impact that we're seeing overseas as in Europe continues to work through those high inflationary pressures, as we heard from other executives like McDonald's today on the call. In addition to that, as we spoke to Mondelez last year, and I believe it was 2021, Ukraine, it continues to be a major business for them. So perhaps analysts hoping to hear more on that front as well.
Huge number in Latin America, about 30% revenues. Brooke DePalma, thanks so much. Good to see you, my friend. Okay, coming up, the Empire State Building, delivering the ultimate insult to New York City football fans on Sunday, and the outrage is far from over. We'll break it down next. Bird brains read the cover of the New York Post after the city's iconic Empire State Building served up the ultimate insult to New York City football fans. The building lit up in Eagles green, following the team's pummeling of the 49ers and honoring their trip to the Super Bowl. The city's most identifiable building, trolling both Giants and really Jets fans as well, lighting up social media and sports talk radio. The New York City Sanitation Department calling the move treacherous. The New York Daily News asking, where's your loyalty? The Empire State Building Twitter feed fanning the flames, initially tweeting, "Fly, Eagles, fly," later writing, "That hurt us more than it hurt you," before spiking the proverbial football with, "We'll see you at the big game," compiling in that tweet much of the negative press onto one video montage. And there is that video. So, Shauna, the question is, I abstain from Twitter trolling. I hate it. I don't do it. I can't figure out the explanation for this, but I love it.
Everyone's getting on board with the Phillies, or with the Phillies, oh my God, with the Eagles, with Philly. What is not to love about this? I love the fact that they had Fly, Eagles, Fly, our fight song. You guys got to come over. You got to jump on the bandwagon. Everyone's doing it. Super Bowl 57.
But if you were a Giants fan, how would you feel?
I probably wouldn't be too happy with it, but I agree. Some of these memes, the trolling that's taken place on Twitter. You mentioned the tweet that we got from the Sanitation Department. Well, the New York City Department of Buildings joined in, tweeting, "How are we going to explain all of this to the other buildings? They looked up to you." So it's funny. You got to take a step back and laugh. I think all the hate, though, that's directed at this, everyone just needs to calm down.
I actually loved it, too. I am, of course, not a Giants nor Jets fan. Mayor Adams called it, quote, unacceptable. I was thinking maybe Tony Malkin, the president and CEO of the Empire State Realty Trust, maybe he was a Philly Eagles fan, but searching through his bio, he looks like a hardcore New Yorker. Tony, we want to have you here on the show. Talk about real estate in the city, what trends you're seeing, and of course, what was behind this move. Come on, Tony.
And talk about your new love for the Eagles. We welcome all the fans.
They did light it up red for the Chiefs later that night.
They did, but that didn't spark nearly as much controversy. No. It's all about the Eagles. Fly, Eagles, fly. I'm going to have you sing this fight song.
You are not.
I never say never. It might even happen live.
Have to be a bet.
All right, well, that'll do it for us today on Yahoo Finance Live. Thanks so much for joining in. We'll see you right back here again tomorrow.